Hello everyone, my name is John Locke from lockeinyoursuccess.com and I'd like to welcome you to the winning trade. But first, the required disclaimer material. This presentation is given for educational purposes only, and we're not broker-dealers or financial advisors, and we're not making any specific trade recommendations. Also, please be aware that your risk in trading options is substantial, and please make sure you are aware of all your risks prior to placing any trades. Also note that in this presentation, we are displaying computer simulated trades, and they are hypothetical. And with anything hypothetical, keep in mind that live results can vary from simulated results for many, many different reasons. If this is your first experience with us, my name is John Locke. I'm a trading performance and success coach with Lock in Your Success LLC. And my team and myself are here to help you win in the markets and in life as well. And today I'm going to take you into the realm of high probability options trading. Now, high probability or income trading, as it's also known, is a different type of trading than most people are used to that benefits from the passage of time, meaning you can make money as time goes by rather than depending on price movement alone in order to make money. What this means is that you can often make money whether the price goes up, down, or sideways. Now, this doesn't mean we're going to win all the time, but it does put the probabilities of us winning much further in our favor than if we were to try and trade from a directional standpoint alone. So there are many, many, many benefits to this type of trading. The type of strategy we're going to be talking about today is an options strategy that we call the V32. Now, the V32 is a shorter term market neutral broken wing butterfly strategy that we do on the Russell 2000. Now, these are non-subjective strategies that do not require charting and they do not require subjectivity. We simply put them on by date and we see how the trade works out. We have adjustment strategies or changes that we make in the trade if things go against us, as you'll see. And we'll get into that as we move forward. So the V32 strategy, in order to trade this strategy, it's going to require a minimum of $3,500. The example size that we're going to do is actually going to be substantially larger than that. It's going to be $35,000. This trading strategy does not have a profit target. However, most of the time when it does well, we're looking at somewhere between 5 to 15% of our planned capital. We do have an exit loss trigger. In other words, when we enter the strategy, we're not planning on potentially losing $35,000. If the trade gets drawn down 7.1% of our planned capital, then we're going to exit the position in our $35,000 example size. 7.1% of that is $2,500. So let's take a look at the strategy. Okay, so what we have here, for those of you who may be a little bit newer to this type of trading, is a piece of software we call analytical software. And what it does is it analyzes the profit and loss profile of the position you have on. Now, when we buy a stock, this isn't really necessary because we know if we buy, say, 100 shares of Disney stock, and Disney's at, say, $150, if Disney goes to $151 and we bought it for $150, we pretty much know that if we have 100 shares, we made $100. Or if it goes down $1, we know we lost $100. But this type of trading is different. It's not really dependent on price movement. It's more dependent on the passage of time. So that being the case, this analytical software is extremely helpful in identifying what the risk profile in your position is. So what we have here is a software called OptionNet Explorer. And on the left side here, we have our expiration cycles. So if you know about options, you know that there are expiration cycles. And this cycle here, for example, is the January 15th, 2021 expiration options for the Russell 2000. We are 30 days to expiration. That's what the 30 means here. So what we're going to do to enter this position is we're going to be using this month's options cycles. Now you can use weeklies, you can use other months, but the important thing is this particular trading strategy starts 30 days to expiration, so we're using the options that are 30 days to expiration. Down the left here, we have our call and our put options. So each strike option is listed here. We can filter out the other options so we only show the 10-point strikes, and that's what I did here. We're going to use put options for this particular position, and we're going to do a structure called a broken wing butterfly. So the asset price is right here. It's at 1960. For entry on this particular strategy, what we do is we figure out what option strikes in our 10-point option strikes are between 17 and 27 points below the money. And in this case here, if I start at 1960, 1940 is 20 points below the money. I go in and I sell options at that strike. Now, in this particular case, we're doing what we call a 10 lot, which means we're doing 10 broken wing butterflies. And what a broken wing butterfly is it's essentially selling options at a particular strike and then going in and buying options at a higher strike and buying options at a lower strike. So since we have a 10 lot here, we are buying 10 1980s, we're buying 10 1880s, and we're selling 1940s. And this gives us a risk profile that looks like this picture. Now, this is a little bit different than the price chart because the asset price actually goes along the bottom rather than the side. So right now, the Russell's at 1960, and this is 1960 right here on our asset price. And then up the left side, or I'm sorry, up and down the right side is our profit and loss in dollars, and up and down the left side is our profit and loss percent according to how much money we actually have in the trade at the moment. Now, this trading strategy has a planned capital of $35,000, but usually when we enter the trade, it's going to be less than that. So you can see that our total risk in the trade, represented by our blue line here, our total risk in the trade is less than $20,000 at this point. Actually, it's $19,000. We're about a $19,000 total risk right now, and we have a peak profit potential of, say, $40,000, which isn't going to happen. You're going to require adjustments. The market's going to move around, but that's the dynamics. So this blue line is what's referred to as our expiration line. It tells us the value of the position at expiration. So in 30 days, the value of this position at any given price point is represented by the blue line. So if we did nothing for 30 days and we let this expire and the price was exactly at 1940, we'd be up about $40,000. If we did absolutely nothing in this position and the asset price was down at 1800, then we would be down $19,000. And of course up here, we'd be whatever the line is showing us. Now, none of this is going to happen because we're not going to hold this position until those things happen. We have our maximum loss, or our exit loss trigger, we call it, of $2,500 drawdown, and then of course, very, very likely going to be making some sort of an adjustment on this as we go along. So this is the risk profile. Then we also have this red line that turns blue and then later turns green. That's what's called our T plus 0 line, and that is the projected value of our position as of today, right? Time, we think of T plus 0 as time plus 0 or today. So what we can do, for example, is we can go in and we can add more projection lines, and you can see how the line changes over time. So this is our T plus 0 in the blue. The next line above that is going to be different dates, going to be a T plus 10 line, and then we have a T plus 20 line, which is up here in gray. It shows you how the value of this position changes over time, or is projected to change over time, rather than price. As you see, it becomes less and less affected by price movement as time goes by as well in certain ranges. So that's essentially what we're doing here, and this is our entry. So again, the market's at 1960. We're going to sell about 20 points under the market. We call it 17 to 27. And that's here at the 1940s. We're going to make a 40-point wing, we call it, or a 40-point strike difference to the upside and buy our 1980s, a 60-point difference to the downside, buy our 1880s. This is our risk profile. So let's just watch this as time goes by. So 5 days go by and the market didn't have any adverse price movements. The market actually went up a little bit. Our profit is up to about $810. And things are going well. Now, the question becomes, well, what do we do to this? What if the price went down? Well, if the price goes down, we have what's called an adjustment strategy. So say the price, instead of coming up here to 2009, dropped back to 1940. Well, if that's the case, in this particular position, most of our risk is on the downside. So what we would do here is we would take this position off and we would reset it. We just basically start over again on our position. Okay. Now we also have a upside strategy to this, and the reason we have an upside strategy is because I want to make more than $810 for, or maybe $1,000 on my risk of $35,000. So what happens is if this position starts to go what we call negative delta, then we're going to make an upside adjustment and try and get more profits to the upside. So right here, for those of you who don't know what delta is, it's right here. We have a positive 10 delta. What delta means is this is what it's telling us basically is if the price goes up $1, this position, the asset price, so if the Russell goes from 2009 to 2010, the position is expected to gain $10.82 in value. If it goes from 2009 to 2008, it's expected to lose $10 in value. As you can see, the value doesn't change a whole lot with the price movement. It changes more so over time. So let's move on here until the 29th, right? So everything is going fine. We had a bit of a down move on the 29th, but this isn't a problem, right? We haven't hit our adjustment point here at 1940. We are still up $1,260. Our delta's climbing a little bit, but everything looks fine here. We go up to the 31st and things level out fairly well here. Again, we pull back down a little bit here in January, and some of our profit goes down, but again, we're not really in any trouble. If the market continues to go down here, we get to 1940, we'll be repositioning this. Well, it's also called rolling it back sometimes. That doesn't happen, right? We bounce back off it. And we finally go here, and the market really takes off. Right, so we're up 70.2 points in the Russell on January 6th. Huge up move. We've now turned negative delta. So we're up $1,960. Our delta has turned negative. If we just sit here now, we're actually going to lose money over time. So we don't want to do that. So what we're going to do here is we're going to make an adjustment. And our adjustment here is simply to take these 1980s, or at least some of these 1980s, and bring them back to 1970 until we get back to positive delta. So in this case here, we did 5. We did what we call a vertical. We sell 5 and buy 5. Options here. And now this is our new position. We're slightly positive delta. And let's move forward here. We get another big up move here on the 7th. We turn negative delta again. We're now up $2,200. We want to do the same thing basically. We want to come in here and +5. Now in the rule set, when we do this, we also have a means within the rule set of automatically limiting your capital in the position. So even though we only have, at this point, what about, let me take off an adjustment here. Even though at this point we only have about $24,000 in the trade, we're still going to, the basic rule sets automatically pull off risk when this starts coming in. You can see we get a risk increase from moving or selling this vertical. So to offset that risk increase, we're going to buy this vertical. If that isn't enough, then of course we go a little bit deeper here. And we just kind of balance the position out. Okay, so let me clear our trades. And this is our adjustment. So we end up We're up 2170. We have total risk still about 23,000 here, and we are good to go. So if we go to Friday, and then Monday, of course, the market pulls back a little bit, but that really doesn't affect us a whole lot. We get another up move here on January 12th. Now this time we are negative delta. We're slightly negative delta, and this would normally require an adjustment. But the reality is here there is no time premium left in any of these options, and making an adjustment at this point is it's not going to. By the time we execute it and everything else, it's not going to make any difference in how much profit we can make. So we would just leave it, and we would let this position here expire here on Thursday. If we look at expiration day, this is going to expire out at a profit of $2,270 on our $35,000 position for a profit of about 6.5%. Now this is a little bit low for a winning V32. The reality is in the implied volatility structure of the marketplace in this particular month, it was very unfavorable for broken wing butterflies. So in a more normal implied volatility environment, we would be making more money in this particular trade, but still a really fantastic result on a very simple, shorter term broken wing butterfly. And that is the V32, this episode's winning trade. If you like what you see here, I encourage you to join us at thewinningtrade.com. That's thewinningtrade.com, and discover how you too can follow along with this and many other great strategies as they unfold on our Options Trading for Income weekly webinar updates. Also, where you can learn about upcoming winning trade presentations and explore past winning trades, as well as receive access to free bonus material, as well as our Trading Success Blueprint. Also, while you're there, make sure you check out our free Trading Performance podcast, where you can skyrocket your trading results regardless of the type of trading you do. Also, if you have any questions or comments or anything you'd like to see on the next winning trade, we'd love to hear from you. So simply comment on the video below and we can get those questions answered for you. Thank you. I hope you enjoyed the V32 presentation, and I look forward to seeing you on the next winning trade.